Let's do the numbers. In a nutshell, U.S. stocks went sideways last quarter while bonds turned in a modest return. Overseas stocks earned 0% too. Year to date, though, all markets are up, well above averages, reversing their fourth quarter losses in 2018. A benchmark moderate risk portfolio a la Morningstar Research is up 13%, recouping the 7% loss it had in fourth quarter of last year. What a difference a quarter makes. The Federal Reserve Bank clipped interest rate twice from 2.5 down to 2%, citing business uncertainty due to global trade concerns. That broke the trend, which began clear back in 2008, of slowly rising interest rates. Interest rate increases are great for those who choose to live on a fixed income, but it creates a headwind for businesses who need to borrow capital. The Federal Reserve has indicated their reversal is not a trend, but an easing which may not be repeated due to trade concerns. Two of the FOMC members, our own Esther George here in Kansas City is one of the two, voted against the drop in rates. Further decreases, even with pressure from Washington, may not be in the works if economic indicators come in healthy. If the economy falters, we may well see more cuts then. But remember the adage, don't fight the Fed. How about corporate earnings this quarter? Well, estimates range from flat down to a 4% loss. Business uncertainty and tariffs are impacting profitability. Most predict a very modest yet positive earnings growth for fourth quarter and 2019 overall. Pretty low positive growth. Based on estimates for next year, we will not likely see a repeat of the 23% or 12% growth which we had in the 2 years prior. With the S&P fully valued at 18 times, what might change this course ahead? An improvement on trade and tariffs, if it happens, may provide the spike to economies worldwide. Passing the USMCA agreement with our two most important trade partners would be a positive, but that's a political football right now due to the impeachment inquiry on Trump. Greg Vallieri says impeachment garners headlines, but has low odds in the Senate. Resolving trade issues with Europe, think autos, would boost our economy and theirs, offsetting a potential jolt from Brexit. So as we know, our big problem is with China. We will likely not get a substantive agreement there soon. We may get something due to politics, and we saw that late last week, but businesses will not commit capital when the ground rules are shaking. Most economists predict continuing volatility. Even while the EU and China economies are lackluster, the U.S. consumer alone drives 70% of our economy. The low 3.5% unemployment rate makes Americans feel optimistic. Our economy could continue to do well enough then with our U.S. consumer offsetting some of the downward pull from the trade front. The markets may be oscillating sideways for some time. Most pros do not predict recession. A few pros are even optimistic. Most experts say we're heading into more of the same. What do you do when you don't have a crystal ball? Diversify over the asset classes to protect yourself from big losses and stay in the market to participate in the upsides when they come.